The price of oil is below its March highs, but it's still more expensive than this time last year. With supplies lower than normal, heating your home this winter could cost a lot more. Joining me now, Global Head of Energy Analysis at energy research firm OPIS, Tom Kloza. Tom, thank you so much for joining us.
Hi, nice to be here.
Excellent. So a lot of people are taking to the road this summer or this weekend for travel. Are they seeing better prices at the pump?
Compared with what they saw, let's say, in the middle of June, they're seeing prices around $3.80, and that's about $1.21. So if you really want to put a bright light on it, you can say that Americans are probably spending about $500 million less this weekend than they were in the middle of June. So that's not bad.
So I'm just curious, we did see this recent price drop, but do you suspect that it will be sustainable?
I don't agree with people who think that we're going to go back to $3 or $3.25. There's just too many crosswinds in the world right now. So I think we'll probably hit a plateau very, very shortly. The one thing we have working for us is that gasoline demand always drops from August to September. Some of the big banks think that it's going to go up this year, but that would be basically contrary to history that we've seen for the 21st century.
So you do make a good point about the summer travel season ending, but then we are coming up into the winter heating season. So what types of costs can households expect, especially in light of some of the news coming from Russia that it's planning to keep the Nord Stream pipeline shut down?
Well, we're not going to see prices that Europe's going to see. But, I mean, natural gas in the United States is probably 1/7 of the price in Europe. And Europe could go ballistic or parabolic at any moment. I think if you live in New England and some of the heating oil states, you are going to be paying perhaps $5 a gallon or more, depending how Vladimir Putin pushes various buttons. And natural gas is expensive. The bright side of it is that in the United States, we're kind of a privileged continent in North America, and the natural gas prices here are about 1/7 of what they're paying in Europe, and perhaps 1/7 of what they're paying in Asia as well.
So I do want to stay on the geopolitics front. We have the G7 countries planning for a price cap on Russian oil. What's your take? Will that do anything?
My take is that when politicians get involved in oil trading and supply, they tend to stumble. And I think the notion of a price cap is probably something that's more of an experiment than a reality. The reality is that we have a cartel, and a cartel that kind of violates all the rules of capitalism on the sell side. I don't think a cartel on the buy side is really advisable. And, you know, one of the things I would stress is that since February, Russian oil hasn't been impeded. It's just been flowing to other countries, mostly to Asia, China, and India. So it's going to be very, very difficult to implement that. I think we'd all like to see pressure on Vladimir Putin, particularly for the citizens of Ukraine and Russia. But I don't think a price cap is something that's going to get much traction.
So keeping the focus on pricing and supply, are there any other wild cards that you see emerging? We are heading into hurricane season, for instance.
There are a lot of wild cards, and we've really threaded the needle through most of this hurricane season so far. But, you know, here in Florida, it starts in September and it ramps up even in October. And if you get a storm in the Gulf of Mexico, whether or not it makes a landfall near refineries, it's going to impede progress, or it's going to result in some precautionary shutdowns. You can't operate a refinery if within 24 or 48 hours they could have tropical force winds, let alone hurricane winds. So it's definitely got to be on our radar screens really into November.
So I just want to take a big picture look at the energy industry, and particularly the investing angle. One would expect that the whole sector would be benefiting where prices, oil and gas prices have been. But you say that may not be the case. Can you break that down for us?
Sure. I mean, I would break it down into oil production, refining, and retailing. And oil production has been doing quite well. People will contest this, but generally the break-even price for a barrel of crude oil in West Texas is about $25 a barrel. So the producers are doing well. The refiners were doing epic returns on gasoline, but now they're making a lot of money on diesel, heating oil, and jet fuel. They'll probably do well for the next 6 or 7 months. And the real beneficiaries over the summer have been the retailers, the public retailers and the private retailers. It used to be a few years ago you could buy gasoline stations for about $1 million or $2 million each. Now they're selling for 2, 3, or 4 times that amount. And it's because major oil companies now believe that there's safety in having a retail arm as well. Don't be surprised to see 3 of the major oil companies put together real substantial retail networks in the next 5 years.
Thank you so much, Tom. That's a lot for investors and households to digest.